Hi, everybody. My name is Rob Gallo, and I'm the Director of Investor Relations at PassiveInvesting.com. I'm joined today by Kelly Garrett, Managing Partner of our Debt Fund and Rehab Wallet. Kelly, a pleasure.
Always a pleasure to be with you, Rob.
So, Kelly, tell me a bit about the Debt Fund and Rehab Wallet.
Well, our debt fund is actually a place where obviously we're going to raise the money, paying our investors, and we're going to go into this, but paying our investors 6 to 8%. And then we take that money and go over here on a debt instrument and lend it out. And this branding name of this company that we lend out on is called Rehab Wallet.
Oh, fantastic. So in terms of, how long Rehab Wallet has been around and kind of how many dollars have been funded since inception, what is that? So
it's been around since mid-June of 2020.
Okay.
One loan in June 2020. And so we've done one loan at a time. Raised at the very beginning, we didn't raise the money. We actually started with partner capital.
Okay.
And then actually once we got through that proof of concept stage, that we were able to actually, that the business was going to come off the ground and be a proof of more than a proof of concept.
Right.
Then we started raising investor capital. And once we started doing that, we've raised, over $130 million in 3 years and 8 months. And we've done over $274 million over here on the lending side. So we've used $130 million to go lend out $274 million.
That's amazing.
Big numbers.
Yeah. So in terms of the actual individual loans, though, what size are those?
So right now we're sub 200K. So the loan amount that we're actually lending out on a daily basis, and I say daily basis because we're closing about 50 loans a month. So we're doing, you can do the math. It's a little over a one deal a month, one deal a day per month. But we're sub 200K. So we're loaning out 200,000. And the fix and flipper is taking the risk of after repair value being about 300K, and they're taking our 200,000 and seeing if then they can do a rehab, fix it up, and get a value of 250 or 300K and make that delta.
Oh my gosh! So explain to me, how long these loans are. What's the average amount of time that it takes?
The terms we like are 6 to 9 months.
Okay.
Now, sometimes it might take a flipper to go over the 6 to 9 months. And if so, we have extension fees and we have different fees that actually allow them to continue on. But we want them to be done in the 6 to 9 month term. And there's no reason why most of these should not be, should be able to not be able to close out in that amount of time.
That makes sense.
It's a very normal time limit for a fix and flipper.
Okay. And so the actual flips themselves, are they single family homes, quadplexes? What's kind of the stereotypical type of asset that you're looking at?
I would say over 95% of our fund is the normal traditional residential 3-bedroom, 2-bath, in a neighborhood. We don't like rural properties. We like to be able to get a comparison or an after repair value inside of a neighborhood.
Yeah.
So, and that last 5% might be a smaller commercial, smaller multifamily that we know the borrower really well and willing to lend that out to them because, again, the experience on the borrower is most important piece of this puzzle.
Okay. So, but primarily it's focused on that single family home, 2 to 3 bedrooms. That kind of is the sweet spot.
Correct. In certain areas that we know and understand where there's jobs, there's migration. And that would be the Carolinas, Georgia. We're not really, I wouldn't call it the Sun Belt because we're not really in Florida. I don't really like there's reasons why we're not in Florida. It takes too long on the foreclosure process. But the Carolinas and Georgia, where we really know our borrowers and know the areas really well.
So you brought up the foreclosure word.
Yep.
Obviously, lending, there's going to be foreclosures. How many have you guys had over the time that you've been lending?
So I said the amount of time. It's 3 years and 8 months.
Right.
We've done 1,363 loans to date, and we've had 2 foreclosures.
Oh, wow.
Yeah.
Is that just roughly doing the math in my head? Obviously, it's 0.0014 or 0.14%. Is that normal?
We're well below the national average, but that's very intentional. We work really hard and have a team that just handles that side. So there's a lot of things that go on prior to that foreclosure.
Okay.
For instance, I'm not telling you that there's just been 2 borrowers that had problems. We've just worked out solutions for those problems prior to foreclosure.
Got it.
And I think that's what we're really good at.
So you basically provide that kind of hand in hand or white glove service kind of throughout the whole process in order to make sure you don't get to that point.
We love being not a bank or traditional bank.
Yeah.
We pride ourselves on relationship capital. And really, I've built my business and I've built my whole career off relationship capital. And so we have a one-on-one relationship with these borrowers. Whereas if a borrower's having problems and maybe if it were just a traditional bank, they might not pick the phone up for them.
Yeah.
But they're going to pick the phone up for us, and we're going to have a relationship, and we're going to fix the problem prior to it going to that far-fetched problem, which will be a foreclosure. That's not what we don't want to lend to own any properties. We want to work out solutions with the borrowers.
I really love that relationship capital phrase. It's unlike maybe a bank where it's just a large institution, you have that personal relationship. So people are there like, hey, they do care about me. They really care if this is successful or not. They're here to help.
Yeah.
That's amazing.
We've definitely strive on that on a daily basis. The whole team, the whole culture's been built around that.
Wow, that's great. So you mentioned it earlier, the 6 to 8%. But if I'm an investor wanting to get in the debt fund, let's say I have $25,000, what does that get me?
6%.
Okay.
So if you come in at the minimum loan amount or the minimum amount to an investor, is paid 6% annually.
Okay.
If it's $25,000 to $100,000, it's 8% paid annually. You can either we have 2 choices with distributions, take your distributions monthly, or B, you can leave your distributions in and they'll compound.
Oh, wow. Okay. One of the risks that people point out when they're looking to invest in the debt fund is the LTVs that we're loaning out at. What's that percentage that we loan out at and why?
Right now it's 70%.
Okay.
And there's a reason for that. We dropped it about 8 or 9 months ago when the market just made a little change. Every market has a cycle, and we want to be, sure that we have enough room just in case the market and the after repair values start changing.
So when you say every market is a cycle, I assume you're talking about some experience from your past life that you're like, hey, you know what? We have to stick at this LTV. Go into that a little bit.
I'm going to say, fortunately and unfortunately, I was in the lending business and in the real estate business in 2008, 9, and 10, and so I was firsthand able to see what happened back then. And while we're a little different, the market is different than it was back then. Okay. I say fortunately I was involved in it because now hindsight is so 2020. And I'm able to actually, run the debt fund and run Rehab Wallet through that lens of somebody that's been through it.
That's really good. So that LTV value that you say is 70%, that's the highest we go, right?
That's right.
What is kind of the average that we're at?
Right now, the fund is at 65.8%. So we're actually even below that 70% threshold that we like to be at.
That makes sense. And when we say determining that LTV, how do we get those numbers? Do we speak to a broker about that, or?
Each loan that actually comes through Rehab Wallet, we actually have we don't do appraisals, but we do broker pricing opinions, which are we call them BPOs. Okay. So every market we're in, we have a professional realtor that we're actually have a relationship with that sends these BPO values back to us. Fortunately, 55% of our fund is in the state of South Carolina, and that's where I have flipped myself for over almost 2 decades. And know this area really well. And obviously the other areas that we're in for because of there's jobs coming in, there's migration coming in, the days on market are lower, and that kind of thing. So we're trying to mitigate any type of market risk. We're not perfect by any means, but because of myself, and there's a few of us inside our small team that we have of 8, 9, 10 employees, that We've had some of us that have been through that 2008, 9, and 10 crisis and was in the lending business at that time. So we're kind of, watching and waiting to see if any type of market conditions change. And that 70% LTV that we're at right now, that max 70% LTV is very intentional to ensure that we mitigate that risk.
So, Kelly, one of the questions that we get a lot from investors is about the risk of when you lend out to a borrower, how do you make sure that they're not inappropriately using those funds? Like, I don't know, maybe just dropping the flip and running off to Cabo.
Good question. Well, first and foremost, when a borrower actually comes to Rehab Wallet, they have a purchase contract, and so we have a purchase amount, and then we have a rehab amount. And so Rehab Wallet's going to loan on both of those. And so what we do is that we hold back those rehab amounts to ensure they're not running off the Cabo before they go and take that money and put into a deal.
Blackjack, for example, they might do that.
Okay, we can do that too.
So basically, you're releasing these funds based on time or like how far they are along on each one of the, let's say, mini projects as part of a flip, or how does that work?
So in a rehab, they actually, and in our terms, we have a 6 to 9 month type of time frame.
Okay.
So once they complete, let's give some examples. Let's say they complete the floors, the roof, and the HVAC. They'll then send us video or pictures showing that those items have been done. They have sent in, prior to getting the loan, a scope of work. And we go back to the scope of work and we say, okay, those 3 items, they budgeted for $10,000, let's say. Then we're able to send that $10,000 to them. But they have to do the work first, send the videos, sometimes invoices for the material. And then we send the funds. So we don't send them the funds prior, we send them the funds after the work's been done.
So let me ask you a question. What if I took a picture of this floor in here and sent it to you, pretending it's like the floor that I'm doing the flip on?
So we're ready for that. Okay. So we're ready for all that shadiness. So what we expect from our borrowers are pictures or videos. Preferably videos is usually the way it comes through, is that a video is started at the mailbox and they're going inside the home. We've already have pictures of the outside of the home before they did the loan. Yeah. So again, those the BPOs that we actually give are with pictures. And so we know what the outside of the home looks like, and they're walking into that home, showing the floors inside that particular home or appliances or the HVAC. And so they're walking us through that home with, using their phone, which is a wonderful thing.
Yeah, that's great. And so you coach them, it sounds like, on this is the appropriate way that when you finish a project and you need a draw, you start at that mailbox and you go all the way through, because then things just come faster for them.
Exactly. We actually, on the front end of that, have a draw tracker that we ask them to use, our personal draw tracker.
Okay.
We actually have a video to show them how to use our draw tracker. So the more that we're actually kind of in tune with each other, in cadence with each other, the faster they're going to get their funds. Because if the borrower will send in the video correctly on the front end, the quicker they're going to get their money. So that's important to them.
Yeah.
Their contractors waiting to get paid. They've already put the money out, and they're waiting to get reimbursed for that. So we actually have to coach them and work with them along the way, but it's working.
That's great. And then how often do you have to go out to the site to actually do a visit? And what about in sites that maybe aren't necessarily in the Tri-County area around Charleston?
Well, we have to kind of plan for that as we grow, that everything's not going to be within the state of South Carolina, even though I think I've said before, 55% of our business now is in the state of South Carolina. We actually have to be okay with that. And fortunately, with the internet and the phones that we have now and everything else around that we're able to FaceTime if we have to, or site inspections. There's times when we've flown, whatever it took to actually go through and do a personal inspection. The only reason we would do that is that we've had some of those questions of somebody trying to pull something over our eyes.
No, that's great. So one of the questions that we get a lot when we talk to investors about Rehab Wallet and lending is, how do we ensure that the location the risk of making sure that you have the right location for these assets that are flipping. What do you guys do to ensure that it is the right location?
Yeah, you don't ever know, what areas you're going to actually get a loan from, or a borrower's going to be wanting to invest in. Obviously, we like the Carolinas and Georgia, but then you got to drill down to counties, and then you got to drill down to neighborhoods. So it's very important that we have some criteria. First and foremost, we don't like to lend in rural areas just because we can't get the values right sometimes in those rural areas, because you might have a comparison that's 10 miles or 5 miles from the location of the subject property. So we like to stay within neighborhoods when at all possible. So how do we know what the locations are? Well, first and foremost, we're going to send out a broker and to get us a BPO, which is a broker's pricing opinion. They're going to send us pictures, and they're going to send us their comparison analysis of the after repair value. So that's the first step.
Okay.
The second step is the internet. Is that we're able to actually use GIS and actually go get down on the street view and see if a house is beside a junkyard.
Yeah.
Just because it looks a certain way, the neighbors, the actual neighbors of your home is important. And why it's important, because it'll stay on the market a long time.
Yeah.
So location is key. And last but not least, we have the right person in the right seat that is analyzing that. Anna Teixeira is our gatekeeper. She's been in the business, in the lending business now over 2 decades, and knows what to look for in borrowers and properties and in locations.
So that's what you do, kind of those second and third points with Anna, about making sure that maybe you don't agree with the broker's opinion in terms of that. That's where kind of those secondary and third pieces come in.
Absolutely. We've said no to a lot of properties, even though after analyzing it and underwriting it, we've actually seen that, once again, the house is a beautiful house. It's on a bad street, or the neighbors is just, again, I'm going to call it a junkyard because it's been through an experience. I've seen something come through and we had to deny a loan because it's actually sitting beside a really junky neighbor. It doesn't matter how beautiful that our borrower rehabs his property to be. It will sit on the market for a long period of time, and that value is not a true value.
That makes sense. That makes sense. So, Kelly, one of the questions that we get about the debt fund, and specifically a risk, is how many foreclosures or how many defaults have we experienced in the debt fund? So would you mind kind of sharing, what we're at right now, and how do we mitigate that?
Right now, I'm proud to say we're at number 2. So we've had 2 foreclosures and 1,363 loans to date. And so we're super proud of that. I don't expect it to stay that low, and I'm just going to go ahead and just put that out there, because as we grow, the odds are defaults are going to grow.
Yeah.
It's just going to happen. Life events happens. Borrowers have their own daily activities in life too. So if something happens with a borrower and they don't pay us, we have to go through a foreclosure auction. Now, what we try to do and be really good at is that we try to solve the problem before it goes to foreclosure. So that's the things that we're really good at right now. So have we had a lot of problems with borrowers other than 2 of our borrowers? Yes. But what we've been able to do is solve the problem prior to getting to foreclosure.
So if someone, let's say, comes to you and they say, hey, I'm having a little bit of problem finishing this part, or let's say making that next payment, what do you do exactly, let's say, if they want to extend that loan?
Well, we have inside of our promissory note, we have, the proper documentation to say there's a fee if you want to actually extend the loan another 3 months. So sometimes we understand, not sometimes, but we understand that it happens sometimes that you might extend it past 6 months. You might think that that I flipped for over 18 years. So I know what can happen. You might get into a deal or a property and have no idea that you're going to have problems underneath the house. Yeah. And all of a sudden these problems arise, and it just takes longer and longer. Or permits. Sometimes you expect a county to be back in 2 weeks with your permit, or 2 days, and it's 2 months from permitting. So that's circumstances that we have to understand. And that they might have to go through an extension fee, or extension period, but with that comes a fee.
That makes sense. So I got to ask you, so 2 out of 1,363?
That's right.
That's about 0.0014 or 0.14%. Is that normal in the industry?
We're well below national average with that number. Okay. But like I said, what I think we're really good at is solving the problem prior to going to foreclosure. For instance, we'll have a borrower or introduce another one of our really good borrowers or one of our VIP borrowers that has done multiple loans with us and introduce him or her to the borrower that's having problems. And sometimes they can actually lock arms and partner, or B, they could sell the property to that borrower that actually is experienced or has done a lot of loans with us. And we'll actually fund them and allow the borrower that's having a life event or a problem for him to get out of it.
So that capital relationships that you have built with not only that specific borrower that might be having the problems also helps with other borrowers that you could bring in to actually help that single borrower that's having the problems.
Yeah, it's been a win-win relationship. And I've said it before, is that we're big on relationship capital. That's our currency really at Rehab Wallet.
Yeah.
And we'll continue to do that. Will we have more defaults moving forward? We might. But at the same time, we're going to continue to do what we've always done, and because it's worked.
That makes sense. And the other last point I wanted to ask you about this was, obviously you do a lot of work in South Carolina. But what about Georgia and North Carolina? I imagine, there's some different foreclosure proceedings in each one of the states. How do you stay ahead of that?
Well, number one, we have we've hired about two years ago. I think it was like first quarter of 2022. We hired a compliance officer, and we put again the right person in the right seat, and she brings a ton of experience and a ton of detail orientation that's part of her character, and the ability to actually get stuff done and working with relationships with a borrower. So she does phone calls prior to things happening. For instance, let me give you an example. So let's say somebody's in their 6-month term, or they have 6 months in their term of a certain loan, and they're in the 3rd month and they haven't taken their first draw. Well, there might be a wellness check. That's what we call it. We just pick up the phone, call the borrower, and ask him or her how things going. I see you haven't taken your first draw yet. Is there a problem? Because you only got 3 more months to finish this project. So there's things like that. So I'd have to say the answer to the question would be the right person, the right seat. And fortunately, we've hired the right one.
That's great. And then just an understanding, I'm assuming, of all the foreclosure laws in each one of the states is probably something also that you guys pay attention to and have to abide by.
We do. Now, we're not in a ton of states.
Yeah.
We're in probably maybe six total states. Amanda, which is our director of compliance, has to know every foreclosure law for each one of those states and procedures. There's a time of a month that they have auctions of which month is it, what day of the month it is, how long it takes, how many days is it that you actually have to put the proceedings inside of a newspaper. All the details of each one of those states, Amanda has to know.
Yeah.
And so we've had to learn all that, and we have.
That's great. So, Kelly, one of the questions that we get a lot when we talk about some of the risks for actually investing in Rehab Wallet doing lending is lending regulations. What type of lending regulations do we have to abide by when we're actually making these loans to the borrowers?
Fortunately, very little. And this was our choice and why we wanted to go with be a hard money lending company. Now, let me explain. There's different laws that's on the books for consumer loans, and we're just not doing a consumer loan. We're not a consumer product at all. We're lending only into entity names. So all of our loans that we're doing is typically inside of an LLC.
So then the borrower themselves has to have an LLC or some type of entity set up, correct?
That's right.
And how do we double check that?
Well, part of our documentation that we expect at the prelim of every loan and the processing piece of it is that we collect their articles of organization for their state that they're actually incorporated in, and their operating agreement for that particular entity.
Okay. So when you said the consumer lending, that's probably what the Dodd-Frank Act.
That's right.
That basically covers the consumer lending, but because we lend to entities, we aren't regulated by that from a federal perspective.
Federal.
Okay.
State to state, the regulations within the state to state, it's within the documentation.
Okay.
So every state will have different documents. For example, in the state of South Carolina, we use a mortgage to lien the deed. In another state, I believe it's Georgia, they use a deed of trust. So every state is different, and obviously that's part of our job to ensure which state uses what documentation. The performance of the documents are the same. It's just the name of the document is very different. So we're able to have all the documents needed and have to know that on the very front end of which state we're in. Fortunately, due to the size of our fund, while it's large for us, it's not very large in the lending world. You know, we'll get there, but it's not that big in the lending world. So right now we're in 5, 6, 7 states, and so we just know everything, all the documentation needed inside that state.
So obviously we have to abide by all the individual state regulations, but we are not regulated by the Dodd-Frank Act. Correct?
That's right. That's correct.
Great. So one of the questions that we get a lot when we're asked by investors, and speaking about risks, is how do we ensure that we're vetting the borrower appropriately to make sure that, hey, this loan that we're giving you, that you're going to pay it back. So what is the process that we take these borrowers through to just make sure that, they are going to pay us back?
Well, the first thing is their experience, and that's what we have to vet, number one. And we need to see that this borrower has done at least 2 loans in the last 12 months, 2 deals in the last 12 months. And so that shows us that they've actually, and that's from the front end of a loan to they've actually fulfilled the whole thing and closed it out.
So the whole cycle.
Correct. So we're able to get that documentation, and we will get their closing statement or their HUD settlement statement showing that they fulfilled those obligations. That's the number one thing. The other thing might be that they've been able to do a loan this size, like anybody. And I've told you before, I flipped myself for almost 2 decades, and it's different flipping and dealing a rehab of $30,000 versus $130,000. When you get over 6 figures on a rehab, you better have some experience. So somebody that has only done 2 loans in 12 months, and that's the only 2 deals that they've ever done before, and they're trying to come to us for a $200,000 rehab, we probably will deny that loan.
Yeah.
It takes a special person to be able to do that, and that would be a very experienced borrower. And that person probably have been in the business for multiple years and has done a deal and a rehab of that size.
So you've also talked to me about relationship capital. And I think that's probably one of the pieces too that fits in here. So tell me about the network and the relationship capital that you build to make sure that you've got the right borrowers kind of in that network.
That's the biggest thing for me is, and I've told you before that we really bank on this relationship capital, and that's how I've built my career for almost 3 decades, is the fact that we're one-on-one with these borrowers at these investor networking events. We attend them weekly, sometimes twice a week. Somebody at Rehab Wallet is at an investor meetup at least once a week. And again, like I said, sometimes two times a week. I facilitate one and own one in the Charleston, South Carolina area. Over 100 people come to it once a month. And then we have subgroups within the month. And so we're very active in there. That's how I've built my career. And our borrowers are at each and every one of these events. And so we have a one-on-one relationship with it. I feel like that's what's kept our default ratio. And we've talked about that before. We're only 2 defaults and 1,363 loans. That's what we've been able to keep that number down. Is because they really don't want to upset us. I truthfully feel that way. And we're going to solve this problem together if there is a problem. So the one-on-one relationship and seeing everybody on a weekly, sometimes monthly basis keeps the relationship strong.
And I have got to believe that there's a lot of networking, or, hey, I've got this problem. And then they're going to ask, the other borrower that's in the room that does this all the time, and kind of get that, oh, do you know a contractor that, does tile really well?
Absolutely. But both me and Danny Randazzo, the other partner inside the fund and Rehab Wallet, are locally to Charleston. He had a breakfast meeting for years that 25, 30 people were at twice a month. And those same people are also at my networking event once a month, and then the subgroups. And so we're very networked in the tri-counties of Charleston, and each one of the larger cities within these 6 to 7 states that we're in, they too have their own networking events, and we attend them on a monthly basis.
So let me ask you a question. What would be like the biggest difference between what you guys do to vet your borrowers versus a traditional bank that's lending out some of these types of loans?
Again, I'm going to continue on with this relationship piece. I feel like the banks and the bigger banks, it tends to be a piece of paper or somebody coming over across their computer instead of a face-to-face relationship. So I would say the relationship building would be the biggest thing. And then we take the time to work with our borrowers if they do have a problem. At the same time, I coached entrepreneurs and real estate investors now for almost 10 years, and I'm coaching those same borrowers on a daily basis. So we're very involved. Like I said, that's my currency is relationship capital. That's what the culture of Rehab Wallet has been built on, as well as our debt fund. And I don't see why that would ever end. Call it old school. We're not behind a computer with a relationship over a computer. We're face to face and a shaking of the hand, breakfasts and coffees and lunches. And I still think that we'll continue on that, and that'll carry us through.
So Kelly, some of the questions that we get when investors are asking about the debt fund and obviously Rehab Wallet is the risk of having slow demand, because obviously if we don't have the demand for the loans, then we're not going to be able to actually fund any loans and then therefore not be able to pay some of our investors. So how do we mitigate that risk of having that slow demand?
Well, fortunately, we hadn't had to deal with that yet. As our fund on the capital raise side has increased, then we have to balance that over here on the loan side. And so as it has increased, we have added employees. And so recently we added, within the last couple of months, actually, we added another loan originator. And that person now is able to hit the Raleigh, the Charlotte area, and Charlotte, North Carolina area. And there's a reason why we like to be in those areas, because it fits the other criteria that we like. And that would be migration, jobs, et cetera. So we like to be in those areas, and we've just added employees as the fund side has increased.
So in order to drop, let's say, some of that new demand or really kind of be known more, what are the steps that you take or the team takes in order to make sure that people understand that, yes, Rehab Wallet is out here as an alternative to some of the banks that might be out there as well?
So we're at a lot of investor events.
Okay.
And so that's our avatar. We go to where our borrowers are, and they like to network. They like to be with like-minded people, because that's where deals are made and the money is that, and the contractors are at. And so there's tons of networks all over these areas that we invest in. And we are fortunate enough to be involved in sponsoring a lot of these. And so that's the number one thing that we like to do, is sponsor these events, take our booth, and have a representation of Rehab Wallet there with all of our swag on, that they know who we are, and create relationships there.
What about social media or some of those other channels that we see used a lot?
We like to be on a lot of stages, and a lot of podcasts and a lot of webinars. We actually, I think, are good in both two different worlds. In the world of I'm gonna call it old school, where it's face to face, shake of the hand, coffee and the lunches, as well as this new world of the internet and social media that we have to jump into. And so, I'm on a lot of stages. In March, I'm actually on 3 different stages, talking about Rehab Wallet a lot, talking about our fund. My COO, Angela Dunn, is on a ton of webinars. Actually, we're developing, Harris Jones, our director of operations, the same thing. It's actually developing her to be in some other stages and to be in some other webinars and social media. It's just important that we're there and to let everybody know who we are.
That's great. So I have to ask you, because I think in, let's say, Q3 of last year and Q4, definitely we saw kind of a slowdown in credit being available. How has that impacted our business?
Well, when the banks kind of tighten up their credit, Rehab Wallet gets busier. So let's say we have a borrower that's very bankable, and they might have a job, they have a W-2, and easily and has time to wait. You got to remember, a lot of our borrowers don't have time to wait. But let's say a borrower does, and they can have the time that the banks take, 30 to 45 days. So If that credit dries up, then those bankable borrowers and that have the time to wait, they're just going to come over to Rehab Wallet. So we've actually gotten busier as the credits dried up there in the traditional areas.
So Kelly, one of the questions that we get from some of our investors is, what happens when we can't sell that house? So the borrower has, finished all the actual flipping and fixing and whatever they have to do to that house, but that house is just sitting. So how do we help mitigate that risk?
When we see that a deal is staying on the market too long, days on market is a key phrase in our industry, right? DOM, or days on market, and it's just staying too long on the market. We'll actually reach out to the borrower and ask, and see exactly, is there something we can help them with? So I would say education through some of our experience would be one thing. The other thing would be that we would actually offer a solution. And one of the main focuses of the solution is to possibly change real estate agents. And suggest that off the bat is that we have a lot of real estate agents due to us using broker pricing opinions in a lot of BPOs. So we have a lot of relationships in the industry of very professional realtors that get stuff done. And so we might introduce them to a new realtor that actually can take it off the market, maybe change the pictures, maybe change some staging or add staging, any other component that might move this house. And so a lot of times we have been able to introduce them to a professional realtor, then they relist the property and it gets sold. So it's, instead of us just sitting back and doing nothing,
right,
we're actually reaching out to borrowers and saying, how can we help?
Yeah, that makes sense. What about a scenario where the borrower actually is finished with the flip, but they want to hold it, and maybe they're having problems with refinancing? How do we mitigate that risk?
That started happening a good bit because the more loans we have, the more opportunities this could be a problem. And so we really wanted to control that situation, to get it off Rehab Wallet's books. And in order to do so, Dan, Danny, and myself partnered up with Whit McCarthy, who had tons of experience in this long-term lending arm. So we started a company called Consistent Capital, within the same partnership, but a different lending arm of PassiveInvesting.com. And so now we're able to control the situation. So we can actually take the borrowers that are having problems, possibly not refinancing with a traditional source, because maybe they're not, I don't know, maybe they don't have good customer service. Maybe they're not calling them back. Maybe they're just dragging it out. Now we can actually can control it and get it off Rehab Wallet's books and just put it on Consistent Capital. So what we've been able to do is just start another business, with an amazing team. Whit has built this team out with just rock stars from his previous life. And now we're actually to control the situation, and it's working out great.
Yet another way to mitigate those risks and make sure that our investors get their cash back.
Absolutely.
Absolutely. Well, if you want to learn more about our debt fund and Rehab Wallet, you can visit our website at PassiveInvesting.com, or you can reach out to me personally, Rob at PassiveInvesting.com. Kelly, thank you.
Thank you, Rob.